Good morning. This is Larry McMillan with a stock market update on Monday, May 6th. So last week, the market rallied right up to the declining 20-day moving average. It looked like the typical oversold rally. It hit that on Tuesday and fell back sharply. So it seemed like the bears had a pretty good chance at that point to, push the market lower. They didn't. And what happened was a rather benign commentary from the Fed on Wednesday, and also a sort of Goldilocks number from the unemployment report on Friday produced a big rally and is continuing this morning. So the oversoldness of the market that we saw 2 weeks ago had launched this rally, but now it's running on its own. And so there's a chance that the bulls are really going to take control back here. They haven't yet, but it's a possibility. So right now the S&P has resistance in the 5150 to 5180 area. And then, of course, above that, there's resistance at the all-time highs around 5260. Friday produced a gap on the chart. So if that gap were filled at 5070 and the market traded lower than that, then that would be negative. But right now, it looks like it has its eyes on the upside. We'll see if it can really break through here. Equity-only put-call ratios have remained bearish in that they're still rising. Actually, they fell a little bit on Friday, but there are 21-day moving averages, so one day doesn't usually indicate a reversal there. But it's possible that those could roll over as well. There is a McMillan volatility band buy signal in place with a target of right now 52.65 on that signal. The breadth of the market has been very strong in the last week, really almost 2 weeks. And so the breadth oscillators are back into overbought territory, which is good. When the market is rallying strongly, it's good to see breadth overbought. And so those oscillators are on bullish signals as well. New highs registered 100 on Friday, and that's the first time we've seen that in quite a while. If they do the same again today, and it looks like they might, that would indicate a new buy signal based on new highs versus new lows. Now, this signal has been bullish really for most of this year, extending all the way back into last fall, with the exception of a couple of days here and there. So if this turns bullish again, that's another longer term indication that the market could move higher. VIX closed below its 200-day moving average for the second day in a row on Friday, and that negated what had been a trend of VIX sell signal. But there is a trend of, not a trend of VIX, but a spike peak VIX buy signal in place. So that has a bullish aspect to it right now as well. That'll remain in place as long until VIX jumps 3 points higher. That's not happening today, that's for sure. The last thing is the construct of volatility derivatives. There was a little bit of nervousness about that in the last couple of weeks, but basically it's remained bullish, and now it's taking on an even more bullish status since the term structure of the VIX futures and of the CBOE volatility indices, those term structures are sloping upwards. So overall, we're trading all of these signals, but overall we have still a negative S&P chart unless it can close above 5180. And so the other indicators, although they are certainly turning more bullish than they had been, are in something of a secondary status to the S&P chart, and always are. The S&P chart is really the main thing that controls, obviously, prices of the market. So we're watching all of these things carefully. I invite you to visit our website and take a look at the trials we have for our daily letters so that you can keep up to date on these things in a more timely manner. And meanwhile, have a great week trading.